the things that's all the rage right now is this talk about tariffs and stock market downturns. It reminded me of a video I did a while back, and wait till you see the outcome after I did that video. I'll hold that till the end. But check out what I said here regarding being too old for downturns. There's a phrase I hear from investors quite often, especially older investors, when we go into market downturns. I'm too old for downturns. They're basically saying, I don't have enough time to recover from a market downturn, and typically means they want to move their money to cash. So that's really what's going on for a lot of people. Move the money to cash. Now, by definition, market timing is changing your asset mix based on a prediction or a forecast about the future. And when we're doing this move to cash, we think it's self-preservation. But what we're really doing is we're completing a pattern in our minds. After the market goes down, what we do is we go, I think it's going to continue to go that direction. So if we look at the stock market and why, and I actually referred to this in the first video, and why we invest in it, there's a really good reason, and that is to protect us from inflation. Stock market has historically been the best hedge against inflation. Take a look at this. What you're noticing right here is that stocks after inflation have significantly had a higher return than fixed income investments. I mean, look at fixed income investments like treasury bills or CDs. The return has been either very, very low or even negative after taxes versus inflation. So that's why we invest in the stock market. Because what is inflation? Prices going up. Who's raising prices? Companies. What do you own when you own stocks? You own the entities raising prices. So that's why we do that. Now, in the video, I actually talked about life expectancies because we're saying, are we too old for downturns? And I want to examine that right here. So let's look back at the first video that I did on this topic. The other thing is, I want you to think about this. Life expectancies. If I am a 65-year-old male, my life expectancy is still about 17.8 years. For women, it's about 20 years. Joint husband and wife, about 27 years. If we look at a 75-year-old male, it's about 11 years, about 13 years for women, and jointly about 18 years. And for an 85-year-old male, it's about 6 years, about 7 years for a woman, and jointly at about 11 years. All of those periods in time are significantly longer than it has taken, according to the New York Times, to have historically recovered from a market downturn. So we notice that historically market downturns don't last that long, most of them. And I'm referring to this New York Times article that actually showed that you count the number of days, not years, when it comes to stock market downturns historically. It's pretty surprising to most people to see how short they typically are. But in the article, what we did is, I talk about this in that previous video, is we look at various downturns because that's the average number of days. Sometimes it's longer, sometimes it's shorter. So some downturns were 270 days or 145 days, 322 days. But some downturns were only like 25 days or 28 days. So it really varies, but the point that I was making is that typically life expectancies far exceed the number of days it takes to recover from market downturns, or the time from trough to recovery. But somebody might look at this and say, well, you know, this downturn is worse, Paul, and I actually addressed that in the previous video as well. Check this out. But this has been a bigger downturn than that, Paul. I mean, we're looking at the coronavirus. It's been much longer. Well, it's been more like maybe 1973, 74, right? So you might be looking at that and go, oh, he's talking about the 2020 downturn, and you'd be right. So I'm pointing out the 1973, 1974 downturn, which was the oil crisis. I mean, it was really nasty. We were worried about the future of our country as far as our energy source was concerned. And I actually showed that if you were a more diversified investor, and older investors wouldn't be all in stocks. I looked at the 73-74 period, and you notice that even if you were in an aggressive portfolio, it only took to the end of 1975 to completely recover from that downturn, and it was even shorter for a 60-40 portfolio. Then you may be looking at that and go, well, you know, even worse stuff than that. Remember, 2007, 2008, it took longer. But if you were in a 60-40 portfolio, it didn't take that long. Not nearly as long as somebody's life expectancy would be by any stretch of the imagination, a very, very short period of time compared to those life expectancies. But you might look at it and say, but Paul, this is different. What we're going through right now, I mean, we're looking at this and going, is Trump crazy with what he's doing with tariffs? You may be saying that. Well, let's look at it and say, is this really different from some of the things that we have faced as investors in years past or times past? You may look at that and go, well, wow, if you look back at the stock market crash during the Depression, certainly an investor during that period of time would have said, that was definitely different. Well, you would have been right. It was different. We hadn't been through that before. Or how about atomic bombs and blasts and nuclear holocaust? We were worried about that at one point in our history. And the funny thing is we recovered from that too. Or how about U.S. energy crisis? In the 1970s we were looking at those types of issues. Or how about an ice age? A lot of people don't remember we were worried about an ice age during the 1970s. And we looked at that and go, wow, space satellites are showing that an ice age is coming fast and it's imminent. Or how about people were worried about the population explosion. And with a population bomb, this could incite worldwide fear and overpopulation. And we could be in for real trouble. And people were worried about the end of the world. And what I want you to see is this. It's always something different. We were looking at World War III. With the World Trade Center, when that happened, we were worried that that was going to happen. Or, 1 in 7 actually at one point thought the world was coming to an end. It's always something different is the point that I want you to get here. There's always something that will scare investors and make them go, I got to do something different. And this is why investors typically get really bad results. Is because when markets go down, they panic. When markets go up, they get euphoric, and they tend to make all the worst decisions at the worst times. Well, if we look at when I did that video talking about downturns, when did I do that video that you've been watching excerpts from? Well, I actually did the video on March 20th of 2020. What happened after I did that video? Literally, I did that video around right there. That was where the market was when I did that video. And what did we see after that? That's an aggressive asset mix. And you look at that and go, wow, maybe the world didn't come to an end. So that's the point here. When we see market downturns, we will always say in our minds, I'm too old for this, or I can't live through this, I can't stand it, I can't handle the risk. When markets go down, they go down because we're worried about, let's say, profits. And I always say that, hey, look, if stock markets go down and they never recover, let's say, and that's really what we're worried about, isn't it? What if the market goes down and it never recovers? If that happens, that means earnings went away. If earnings go away, then taxes go away. If taxes go away, then the government goes away. If the government goes away, then the FDIC goes away, or all our guarantees. So the reality of it is markets have always recovered from downturns because we have a lot of different things that we can do to cause stocks to go back up. If we can't increase sales, we decrease expenses. I never worry about market downturns. If you look at a stock market chart, you see it does this all the way through history. We've been through a lot, and the reality of it is we'll continue to go through a lot in the future because that's the nature of life, ups and downs.